seeing the recordings, right? As I'm posting those up. So I'm trying to get them up as quickly as possible. It may take me a day or two sometimes, but you should see the recordings pretty quickly after the class, day or so, I guess, is what I'm shooting for. But um, we had started chapter 2, and we did spend our time talking about the balance sheet, which is called the statement of financial position, um, statement of net position, excuse me, for uh, the government-wide statements. Okay, and some of the key takeaway from that discussion was that we would have what? All of our assets, current and non-current, all of our liabilities, current and non-current, and then the way the statement was presented is the bottom line, unlike you see in a commercial style of a balance sheet where they add the liabilities and the stockholders' equity together, add that up, total that up, and then you see that that matches the total assets, right? Assets equal liabilities plus stockholders' equity. They kind of prove it by adding the liabilities and the stockholders' equity together to total up to the same number as the assets. In government, at least at the government-wide level, we don't do that gross up of the liabilities and the net assets. We simply report the total net assets and we stop there. Okay, so that was the setup, assets, the structure. And remember, guys, we're still sort of we're getting a little bit lower than the 30,000 foot range that we're actually looking at the statements now. But we're still at a fairly high level here where we're just understanding the structure of the financial statements. And for the government-wide statement of net assets, statement of net position, it is what? It is going to be our assets equal liabilities plus, and then we have the net position, but we just stop at the net position. We don't add the liabilities and the net position back up together to total up to the assets. Okay. And remember, we had 2 columns. We had governmental activities and business type activities. Governmental activities included all of the governmental funds. So I gave us that mnemonic grasp: general fund, special revenue fund, debt service fund, capital project fund, plus the internal in our little mnemonic grasp C KIP. We just had the S for the internal service fund, but I also wrote ISF there. Those all get rolled up into governmental activities. And then we take our enterprise funds and we roll those up into our business type activities. And we talked about our component units last time. And we said that this would be an example of discrete presentation of component units. And I think that set us off where we went looking. Oh, it was interesting. Let me pause for 1 second. I don't know if you all ever watch Sunday political talk shows. You're probably studying, but there's a show called GPS. It's a show that's on CNN that is hosted by Fahid Zakaria. And it was interesting because he was talking about the amount that the U.S. spends on defense versus other countries like China and whatnot. And the U.S. defense budget kind of dwarfs all the others, was his point. And then he made the point that the Department of Defense, and the way he described it was, well, the Department of Defense doesn't get a clean bill on its financial statements, nor does it get a bad bill on its financial statements. The auditors, and they have hundreds of auditors, he says, that come in, and the auditors end up saying that they can't give any opinion on the financial statements because of the illogical process that the Department of Defense uses to put their financial statements together. And as a CPA, of course, that works for the government, I'm sitting there saying, well, that's a disclaimer. No opinion is a disclaimer opinion. That's horrible. That's saying you have such a mess that we have to walk away shaking our heads when we look at these financial reports. So I was just sort of really enjoying that presentation because we had our conversation, I think, on Thursday, where you all were sort of reading me all the wonderful things that Department of Defense said that it tried to do to get the financial statements audited, and then in the end, they still got a disclaimer. So it was kind of interesting that that actually made its way to the Sunday morning talk shows right after we talked about it on Thursday. But we kind of got off on that tangent a little bit when we flipped into the city of San Jose's financial statements. And remember, we were looking for component units, and it was uninspiring as to the nature of component units, but you would show them in a column or format using discrete presentation, and you would only use blended if you saw the specific criteria for blended, meaning that the boards were substantially the same, or that component unit existed simply to serve the primary government. And so that's a rare case. So most component units would be displayed the way you see here using this discrete presentation. Now, what we did was we also sort of tried to understand, well, since we're using accrual accounting here, and this is a consolidation of the fund financial statements, can we add up something at the fund level and see it consolidate up to the government-wide level? So we did a little exercise here with these example financial statements where we took two enterprise funds, and now we're down at the fund level. We're down at the fund level. We're dealing with our enterprise funds here. Notice it's our proprietary fund statement. So yeah, we talk about the internal service funds at the fund level here, but in terms of rolling up to our consolidated, we're only, for the business type activity column, we're only going to be able to look at the E's, the enterprise funds. So we added these two enterprise funds together, and we saw that the net position was $1,835,000 when we consolidated our two enterprise funds. And so when we brought that back up, it tied to the business type activity column at the government-wide level. Okay. Now, we said, wouldn't it be nice if we could also do that right now for our governmental activities? And we said, no, can't do it because when we're dealing with governmental funds, we're using modified accrual accounting. One of our big challenges in this class is going to be to understand the difference between modified accrual and full accrual. And we don't necessarily understand all of those yet. So it's too early for us to see how we can reconcile the government-wide statements that are using full accrual versus the governmental funds at the governmental fund level that are using modified accrual. But we did sort of say, well, someday this whole thing will make sense to us, and that you would start with fund balance, and then you make certain adjustments to that to reconcile to the government-wide statement of the amount of net position for the governmental activities. And sure enough, that number does reconcile up to the government-wide governmental activities, but it requires some adjustment as we start making adjustments for things like adding fixed assets that aren't going to be reported at the governmental fund level, that are reported at the government-wide level, and so on. And again, we're going to continue that journey today as we understand some differences between the government-wide funds using full accrual, government-wide statements using full accrual, and then our governmental funds using modified accrual. For example, we're going to spend a good chunk of time today understanding the difference in revenue recognition between full accrual and modified accrual. So we'll get through some of that today. That's sort of a review of some of the key takeaways from last time. Any question on any of that? Okay, good. Then let's go ahead and talk about We're still at the government-wide level, or we're starting at the government-wide level here with the government-wide level. And now we're going to talk about the income statement. But rather than call it the income statement at this level, we call it, for our government-wide statement, we call it the statement of activities. But it's like the income statement. Okay. Now, I start with the actual example of the statement of activities, which is a government-wide statement. Okay, it's a consolidated statement. I start here because I think it's easier if you go through this example statement with me, and then we'll look at some slides coming out that will call out some of the key things. But first, we're going to get a visual in our mind of what this looks like. Okay, so a couple of things to realize right out of the gate. We still have what? We still have governmental activities column. We still have business type activity column. So just like we saw on the government-wide statement in that position, the balance sheet, we're also seeing what? Governmental activities and business type activities for our income statement, for our statement of activities. Okay. Notice that we still talk about the primary government, and we still talk about its component units. So at a high level, the structure is the same, but of course, this is an income statement instead of a balance sheet. So of course, we're not going to have listed assets, liabilities, and net position. Now we're going to have listed what? Revenues and expenses, right? So you come over and notice we list those expenses for our governmental activities. And right at the top of this statement, we start calling out expenses. So that's kind of interesting for us that have been studying commercial accounting for a long time, that unlike an income statement in commercial industry where you generally start with revenues at the top, we're going to start with expenses on the government-wide statement of activities version of the income statement. So notice we start calling out our expenses, and we call them out by program function. Okay, programs and functions. Again, we're going to be looking at some slides here in a little while that will give us some definition on some of these things. Programs and functions are things that governments do. Okay, so government programs, general government. Let's look at the second one, public safety. Does the government keep you safe? And everybody always says, no. Yes. They try, right? They spend money trying to keep you safe. And some people would say maybe they spend too much on public safety. You know, when there was discussion this summer about, you know, defund the police, and I was making the point to my friends that want to listen to me when I've had a couple of glasses of wine, whatever, but I was making the point that, you know, the question is not defund the police, it's more of a line item. Where would you rather police public safety funds go? If you just say defund, well, you may be taking away desirable activities. So maybe there's certain things like, do the police really need a budget to buy a tank? You know, do the police really need a budget to buy a drone? You know, and so you could come out and say, well, no, that's too much. They don't need, you know, paramilitary equipment to do their job. But then you see something like what happened yesterday in Colorado, and then you start thinking, well, maybe there are times when they need some of those things. So maybe it's a question of what is the volume of those things that they need. But these are the kinds of decisions that would be being made from a policy-driven budgetary consideration. And then as those funds are spent, then they would be reported here on this government public safety line item, because public safety is certainly something that we've understood that the government should at least be involved in. So you take a look and we have public safety, 1,025,000 in expenses. They get some allocation of indirect expenses as well. Now, right there, we've started our income statement, our statement of activities, showing you the expenses of public safety. Now, this next three columns fall under the heading of program revenue. And what program revenue are revenues that are generated by this government, and it's revenue that's generated by this government to defray the cost of public safety. And so you start taking a look at some of these, and the first one here is charge for service, and this government raised $78,000 of revenue charging service for public safety. Now you look at that and you say, well, how would the police department charge for public safety? Any thoughts? I mean, they raised the 78,000. Did I hear something?
Can you repeat the question one more time?
Yeah, how would a government raise $78,000, whatever, providing safety to the public?
Tickets,
Huh?
tickets, fines, fees.
Tickets, it is listed in there. Yeah, tickets are rolled up in there. Now, the problem that I have is, well, why don't they just have a line item called fines and penalties, on here? And I think part of the problem is they don't necessarily want the whole world to know every dime they raise from fines and penalties. So they do bury it in charge for service. When you get pulled over and you get a ticket from the police, do you feel served? I know I don't. I feel like, how dare you give me a ticket, right? Okay, so they called it charge for service. It's in there, yeah. Let's say you decided you wanted to hold a rally in favor of lower tuition fees, okay? And what happens? You go, and if you start just marching down the street saying we want lower tuition fees, you're risking that they could come up to you and say this is unlawful assembly. You got to go, right? Okay, and but you could do what? Apply for a permit ahead of time, and if you apply for a permit, then they might actually protect your right to march down the street and express your free speech. And then the cost of that permit would be a charge for service. Okay, but the basic idea is these charge for service defray some of the cost of the public safety, right? Okay. Now you have a couple others in there. You have operating grants and you have capital grants. Okay, and grants generally come to a government like a state or local government or a city that would run a progressive township, for example, generally come from a higher level of government. Okay, for example, the federal government gives money to local police to do things like pay for police salaries, pay for police uniforms, operating type expense. This was a program that was put in by the Clinton administration, in which they decided the federal government would start to provide some money to help fund police. And this is sort of why there was some discussion during the election when there was this issue of defund the police, yes, no. There was a little bit of back and forth, and some people were saying, well, the Democrats aren't exactly clean here in what has maybe been seen as too much policing, and that it was under the Clinton administration that they started providing operating grants for things like police salaries, but then they also provide capital grants for things like, you see, when they have a situation like the Colorado shooting, you see these huge tanks out there as they try to bring these people who do these things under control. That would be an example where the federal government may give them money for those big tanks or for drones, this sort of thing. Those would be considered capital grants. But again, a lot of the criticism under there is, here comes the federal government again. It's already got a huge defense budget going to defense contractors, and then you're kind of paying into that same industry as you start to militarize police. And so Some folks are saying well, people just say defund the police. I'm like, okay, there's probably a line item beyond what you see here, a line item breakout of things that you might be able to look at ways to save some money and not continue to pay all this money into these, defense contractor type activities now, as you kind of militarize police. Okay. Now, this particular government didn't get any of those. Okay. Now, the important thing here, and this is a fictitious government, guys. In this class, I use a fake set of financial statements. One thing I don't like about that McGraw-Hill book is what they do is they just whiz the city of Denver, I think it is, financial statements at you and say, here, figure it out. It's not very useful for teaching, whereas here, we've got a more simplified version so we can really understand how all these things fit together, okay? So Progressive Township, you probably could figure it out by its name, is not a real outfit, not a real city, not a real township. Okay, but you notice going across the top here, we have charge for service, we have operating grants, we have capital grants. So the way to remember what our program revenues are, they are socked away. They are socked away to pay for what? Defray the cost of these government programs. So we net all that and you come over and you notice that this government lost $982,000 providing public service. And then you look and you realize, well, this government is a loser because every single one of its programs, general government, culture and recreation, every single one of these programs lose money. Okay, so you come all the way down in our governmental activities, look at all these loser programs, everything loses money. But then you come down and what? You have general revenues, and these general revenues down here are mostly taxes. Okay, so this is what? This is an upside down. This is an upside down income statement, isn't it? Expenses at the top, right? All of our expenses up there at the top. And then our revenues at the bottom, which are mostly taxes. So this upside down income statement allows a user, remember, Gatsby says, you're the loser. I mean, you're the user, not the loser. You're the user. Maybe I'm the loser that looks at these things, right? You're the user that looks at these things and you want to see how your taxes are paying for the programs. So they do an upside down income statement with the expenses at the top so you can see how your taxes pay for these different programs. And at the end, we have what? We have this nice little amount that's left over, change in net position, which is like net income. So remember, net position is what? Like retained earnings. Well, then our change in net position is going to be like our net income. And in this particular case, this government had $794,500 of a net income. I taught this class some years ago, and some guy stood up and said, why doesn't the government owe the people a refund for that money? And I'm just like, okay, I don't want to get into, refunding amounts that are left over. This government apparently had a little bit left over. And so they sat there and they reported a positive change in that position.
Refunds of 25 cents per person should be issued.
Yeah, it was kind of one of those statements. And I was like, down young Rush Limbaugh. I didn't know what to say. It's like, I don't know, if they decide to issue the refund, generally what happens is the federal government that's the one that ends up playing political games with that kind of thing. And so I think when, I think it was George W. Bush was president, they gave a tax rebate of $600 for each person because it was supposedly the distribution of a surplus that had happened during the Clinton administration. And so they said, well, we're going to give you a $600 rebate. Meanwhile, all it really was it was going to decrease the amount that you would have gotten had you when you filed at the end of the year. So they play all kinds of different, silly little games with these ideas that there's amounts that are left over that should be kicked back to the government, and then they want their name on the check. Meanwhile, the reality is, like we talked about last time, almost every president now is racking up $10 trillion of debt each year. So, I mean, not each year. We're almost getting to that. It took Obama anyway 8 years to put 10 trillion on. Trump put 10 trillion on in 4 years, and then Obama put 10 trillion on in 2 years. Clinton put about, I think I went through this, about 3.5 trillion on in 8 years. Bush the father put about a 1.5 trillion on, something like that. I forget what I said now. I'd have to go back and look, I'll bore you with that. But they all take their turn adding. Meanwhile, they're saying, well, we're going to give you a refund for amounts. Refund? You guys are piling up debt like no other, right? Okay. All right, good. So let me go ahead and, was there a question?
Yeah. If we could go back to the prior slide.
Yeah.
So I was looking at the SOC breakdown, and I just want to check my understanding. So is SOC in the revenue portion of GRASP?
It is.
These are revenues, correct? SOC is referring to program revenues?
They are revenues that are specific to these programs. Notice they're aligned with the programs.
Yes.
Yeah, so it's revenue that was generated by these programs to defray the cost of these programs. And yes, they are GRASP revenues, net of any internal service fund revenue, because internal service fund revenue would most likely be eliminated in a consolidation. Remember, this is a consolidated statement. And
Yes.
so we would eliminate any inter fund revenue. And since most of the revenue that's generated by the internal service fund comes from the other funds, those would have been eliminated out. And then it's important to remember that for our general fund, special revenue fund, debt service fund, capital project fund, and our permanent fund, they would have accounted for their revenue using modified accrual accounting. This is an accrual accounting. So not only would there be elimination of interfund revenues, there would also be what's the word I'm looking for? There would also be an adjustment, there's a better word for that, as we adjust from modified accrual to full accrual to report them here at the government-wide level. Question? Did that answer your question?
I think I'm having a hard time putting it together, but that's okay.
Well, what's the part where it fell apart?
So I understand that we have GRASP, C, and is it SIP or CHIP?
Okay, it's GRASP, C, and it's KIP. Yeah.
KIP, okay.
Yeah. But the fiduciary funds are not reported at the government-wide level, right?
Correct.
So this is just GRASP and C that we're seeing here. And I only paid attention really here to the governmental activity, but we do also have business type activity down here. So those are our enterprise funds.
Do we have, so which are the proprietary funds here?
Well, the enterprise fund is a proprietary fund. and the internal service fund is a proprietary fund. The enterprise funds get rolled up into the business type activity. The internal service fund gets rolled up into the governmental activities column along with the governmental funds.
Okay, great. That
Which-
does match my understanding. Thank you.
which is represented by these, right? So that's why I
Yes.
kind of wrote those there, kind of scribbled them in, trying to show them going in there. But again, maybe maybe you didn't ask all that, and maybe that's what confused you. So maybe I should shut up, but I can't resist.
No, that was exactly what I was asking. Thank you.
Yeah, well, and I just want to make sure that when we consolidate, and the word I was looking for before is converting. We're converting from modified accrual to full accrual. We're gonna have to do that. And we are also eliminating any interfund activity.
Okay, thank you.
Yeah. Mhm. It's because it's consolidation, but it's also conversion from modified accrual to full accrual. Now, we don't have to do that for our enterprise funds because for those, they're both using full accrual, and you don't have to convert your internal service fund activity to consolidate it up. Unfortunately, you have to eliminate almost all of its revenue because it's between these funds. Anyway, stop, John. You got your questions answered. We'll get to some of those other things later. Okay. Question? Okay, good. Now, that's the visual. Here's the slides that basically explain what we just saw, okay? So you had program revenues, right? And you had program revenues, and we had what? We had our charge for service, our operating grant, and our capital grant. Now, we're going to be getting more into this today as we start to talk about non-exchange and exchange revenue. A charge for service is considered an exchange revenue because you pay for the permit, you receive the permit. You pay for a bus ride, you receive a bus ride in an enterprise fund. So those are considered exchange. Non-exchange is what? You pay your taxes and you expect the government to be there when you need them, right? So you pay your tax, and if one day I heard a noise outside my window, my old house one time, so I called 911, and the officer shows up, and he looks at me. I'm like, I'm bigger than the cop, so he's kind of like, okay, I gotta go, you go back there and see what's wrong. So I'm telling him, well, it's back there around the corner, and he's like, well, hang on, I want to see, maybe there's a mountain lion back there or something. So he didn't at the end of that say, now here's your bill for this visit. You call them, they show up, right? Okay, well, that means that your tax dollars, your general tax dollars, are really considered non-exchange, because you don't sit there when you pay your property taxes waiting for some service. When you need it, you get it, okay? As opposed to something like a fishing license is going to be considered more of an exchange, because you pay for the license, you get the license, it's good for a year, allows you to fish, whatever, right? Okay. Now, those were our program revenues. We saw charge for service. Operating grant, capital grants are by definition non-exchange. Okay. The federal government gives you some money. There's no expectation that you're going to go and do something for the federal government. It's that you're going to use the money the way the federal government expects you to, hiring police officers, buying capital type items for the police department, whatever. Okay. Now, general revenue were mostly taxes, and that was what we saw at the bottom of the statement of activities. Okay. Then you come over and we start talking about, again, those program revenues. It was charge for service, operating grant, capital grant. We have the mnemonic SOC, right? Charge for service, SOC. I guess I should underscore service there because that was the SOC. And then we have what? We have exchange and non-exchange, and then we had net expenses. And I've written in some of the things we saw for that program, public safety down there. We had what, a 982,000, and notice most of them were in parentheses, most of them were a loss, okay? And then we came over and we had the taxes down there at the bottom, mostly taxes down there. And then we basically had shown the expenses at the top, both direct and indirect. I think it was what, 35,000 or something for the indirect expenses for public safety. That was a program. Okay. All right. So that's basically what we had on that statement of activities. Any question about statement of activities? Okay, good. If there's no question, then let's just go ahead and take a look here. And they ask the statement of activities, which is a government-wide statement, is designed to primarily to provide information to assess which of the following, and it's the same for both of our government-wide statements, both the statement of net position and the statement of activities. It's an operational accountability focus. So remember, it's full accrual accounting, operational accountability focus that we have for our government-wide statements. We had said that a couple of times before. Question? Okay, good. So now we're going to start to take a look at our fund financial statements. So we're at the government-wide level. We understand the structure of those statements. Now we're going to talk about the fund financial statements, and I have them listed by the type, the fund category, I should say. And notice that my governmental funds and my fiduciary funds have two statements. So let's think about this for a second. Government-wide level, we had two statements. We had the statement of net position and we had the statement of activities. So they had two statements. My governmental fund has a balance sheet and a statement of revenues, expenditures, and changes in fund balance. Also, that's like an income statement. So for the governmental funds, balance sheet, income statement. For my fiduciary funds, we have a statement of fiduciary net position. That's like the balance sheet, and a statement of changes in fiduciary net position. That's like the income statement. So almost all of the fund categories in the government-wide statements have what? A balance sheet and an income statement, right? Although you don't call them by those names, I've given you the names, the proper names for those in red, the correct names for those in red. The proprietary funds also have a balance sheet and an income statement. We call the balance sheet the statement of net position. We call the income statement the statement of revenues, expenses, and changes in fund net position. And then only the proprietary funds prepare a statement of cash flows. The other categories in a government-wide, we don't have a government-wide statement of cash flows. We don't have statement of cash flows in our governmental funds nor our fiduciary funds. Only in the proprietary funds where we have a third statement, that statement of cash flows. Okay, now I put the names in red here, guys, because I will expect you to be able to answer a question on your midterm that says, which of the following would be prepared by the general fund? So what do you need to know? You need to know that the general fund is a governmental fund to be able to answer that, okay? And so then I would call out statement of activities. No, that's the name for what? The government-wide income statement, right? I would say statement of cash flows. No, only the proprietary fund prepares a statement of cash flows. I might say statement of net position. No, the what? Government-wide has a statement of net position. or that's the name of the balance sheet for the proprietary funds and the fiduciary funds, but not the general fund, which is what I would have asked here. And then the last one, choice D, would say be balance sheet. And that would be the correct answer, because I expected you to know that the general fund is a governmental fund, and that the governmental funds do what? They prepare something called a balance sheet. Nobody else does. The thing that the others prepare is like a balance sheet, but they don't call it a balance sheet. Okay? Question on that?
Yes, Professor, may I ask why it's only the proprietary fund that requires statement of cash flows?
Well, the, sarcastic answer is because Gatsby said so, okay? But I think Gatsby's logic there is that really is the one that is more like a business. And so the understanding of the cash flows of a business is a very important evaluation tool that is used in for-profit accounting and commercial accounting. So they thought it would be beneficial to users to understand the cash flow. And also, when you're talking about the governmental funds, even though they're using modified accrual, they're not using full accrual. So reconciling, because remember, what the purpose of a statement of cash flow is to understand the difference between accrual and the flow of cash. But if you're using modified accrual, that difference isn't as stark. So what are you really explaining by showing a statement of cash flows? And then for the fiduciary funds, to a large extent, even though they use accrual accounting, think about the nature of what happens in a pension fund. Money comes in, the money's held for investment purposes, and then at the end, the money's distributed to people when they retire. So do you really get much understanding from the statement of cash flows from them? So how's that for not really answering the question, but kind of answering it?
Yes, thank you so much.
Yeah, okay. A lot of it is, sometimes I look at, some of the things they require us to do as accountants, some of the standards, and this is speaking from a guy who's, been an accountant now for 30 years. Sometimes I look at it and think, some of these things that they're doing, I feel sometimes are to amuse the standard setters, to give them something to do. You have to understand that these boards are made up of 7 individuals who, his whole life is sitting on that board. And they sit up there, like in the case of the FASB, they sit up there in Connecticut, and I feel like sometimes they need something to sit there with a, snifter of brandy at the end of the day, next to the fireplace and say, well, we have this thing called comprehensive income, it's like, okay, give me a break, but they do the best they can to sit there and come up with information that should be useful to the users of the financial reports. And sometimes I just feel like maybe they had a little too much brandy, maybe, and came up with some of these things that go beyond, that maybe exceed their usefulness in terms of being able to see what's going on with a particular entity. But anyway, they decided statement of cash flows would be useful for the proprietary funds, and I can see the logic somewhat behind that. Okay, good. Let's go ahead then, and we know that we have 3 categories, 11 funds. We're going to focus a little bit on our governmental funds first. There are 5 types. Now, it turns out that there's really only one general fund, but you could have several special revenue funds, several capital project funds. There's usually only one debt service fund, and then you might have a couple of permanent funds. Okay, so that's why we call them fund types, because it's not like you're limited to one special revenue fund. It's not like you're limited to one capital project. You could have a capital project fund for as many capital projects as you have, right? Okay, And then, of course, we see our other categories, and we'll get to those as we move along. These are in red, because now we're going to go ahead and jump through a little bit of the discussion of the governmental funds. And as we had said earlier, governmental funds, by the way, I forgot to mention, in addition to operational accountability at the government-wide level, full accrual accounting, it's also what? Economic resources measurement focus. When we are at the fund level for governmental funds anyway, we're talking about fiscal accountability, current financial resources, and the modified accrual basis of accounting. And so we've already talked about that we don't have any long-term liabilities. We don't have any long-term assets. It is what? Current items only. And we give you the classic big difference between modified accrual and full accrual right here. And that if you purchase a long-term item, say you purchased, I think we used a steamroller as an example. I've seen a lot of text literature about governmental funds buying equipment. It's always a snow plow. And in California, I get a little offended by that. Hey, we don't buy snow plows, right? So what our governments buy are things like steamrollers, right? And so what happens, let's say we have a special revenue fund where we have the gas tax, special revenue fund and spends that money on road maintenance improvement. They buy a big steamroller, big wheel to flatten out the road bed. That's a long-term item. The journal entry would be debit expenditure for whatever the amount is and credit the cash. So that's a good example of modified accrual. And that also helps you to start to understand why we only end up with current items, current assets, current liabilities, because when you purchase a long-term item, the rule is to expense that so that we can show that during the period we spent the money on the intended purpose, buying a snowplow that would be used for road improvement. Okay. Okay, balance sheet format. Okay, and notice something important here, guys. It follows the format of assets equal liabilities plus stockholders' equity, in that we sit here and instead of it being, of course, all assets, it is now what? Current assets. Remember, our deferred outflows are like assets, so we list them with the assets. Our deferred inflows are kind of like liabilities, so we list them with the liabilities, and we're going to understand the nature of these deferred inflows and outflows here a little bit more as we move along today. And then we go ahead and we have to report fund balance. Fund balance now is like retained earnings. So unlike we called it at the statement of net position level, we call that like retained earnings net position. Here we call it fund balance. Now, very important. Notice that when we are at the governmental fund level, we do what? We total our liabilities in our fund balance so that it'll do what? So that it will tie to the total of the assets. So we total up our assets, so the total assets, list our liabilities, list our fund balance, add those together, and then we list that total liabilities and fund balance, which ties, of course, to the total of assets. Thus, it is a true balance sheet. Okay, question? So when we look at our example, okay, now we're down at the governmental fund level, and we can see our governmental funds, and then we go ahead and total them up, okay? And you can see that we have our total assets, right? We have our total liabilities, okay? And it's what? It is only current assets, no long-term assets here. It is what? Current liabilities, no long-term liabilities here. Total assets, total liabilities, and then we come over and that totals up to what? We take our fund balance and that totals up to our total assets, right? Yeah, there's a typo on this thing, guys. that I keep forgetting to switch this one out. They fix this later, but it kind of destroys the point I'm making right now. So this number, okay, it's a balance sheet, guys.
So
And
that should be 5491.
something's wrong. I don't,
Sure.
I don't know if it should be 5491 because I don't want to have somebody add those up and say, but Professor, it doesn't add up to 5491, but it should match this number. Does
Gotcha.
that make sense?
Yeah,
You know,
absolutely.
so it's a typo, and they fixed this, and I forgot to put in the fixed one. Okay, those numbers should balance. It's a balance sheet. Total assets should equal what? Should equal total liabilities. But I think when they made this, they made a mistake. And then the person who makes this stuff I consider him a friend. I've never met him in person. We've collaborated on various things over the last, probably the last 15 years. We've collaborated on different things. And yeah, what year is this? 2020? So probably the last
2021.
2021, yeah. So probably the last 11, 12 years, we've collaborated on different things. His name is Tom Cox. And what Tom does is he builds the financial statements from the ground up. I mean, he literally sits there and I think he makes all the journal entries for a bunch of transactions and then turns them into financial statements. So you can imagine what he goes through. And fortunately, I guess he made a mistake on this one. And I called him and said, Tom, what the hell's going on here? And he told me, oh yeah, you're right, I fixed it. And then he sent me the fix, but I forgot. So that's on me, right? Because he's now fixed it. I forgot to put the fix in there, but those two numbers should be the same number. Total asset. And the takeaway from here is we end up kind of throwing the baby out with the bathwater because of that, because it doesn't match. And that what? Unlike the government-wide statement of net position where they just reported net position and they stopped, at the governmental fund level, they do to what you're used to seeing in commercial, which is what? They gross up the liabilities and the stockholders' equity and report that number so that it is a true balance sheet that balances up to the assets. Question? Okay, good. Now, when you look at the fund balance, okay, fund balance is like retained earnings, right? And you know that in commercial, when we report our retained earnings, we could report an unappropriated retained earnings versus an appropriated retained earnings. And the idea there is that unappropriated retained earnings are fairly available for various uses by the company, including what? Payment of dividends, right? Well, what GASB determined is that government should try to do something similar. But what they came up with here a few years back is 5 categories of fund balance that would allow users of the financial statements to determine how available this money was in the fund balance for spending. So it's sort of like saying, yeah, there's probably some restrictions that make this money more difficult to spend. So what we're going to do is we're going to list this money from from most difficult to spend, to the easiest to spend. Okay, so from most difficult to easiest to spend. Okay, so what happens? You have one category called non-spendable. Oops, thought I had green there already. You have one category. Someday, I don't understand why Microsoft, if I'm dealing with their Word and Excel, they have a palette of colors there, right? Don't you think that Microsoft would be, PowerPoint would be the place where you'd really want to have that palette of colors? Yet for PowerPoint, they make me do this silly thing where I have to go find where they have the colors, and then I have to go through all kinds of things to change it to highlighter, and then I have to change it to color. I don't understand why they've made it more difficult for their presentation software to find what you want as part of your presentation. Anyway, what happens? You come over and they have what? They have non-spendable, okay? And then notice everything else that's listed down here is spendable, okay? So we have what? We have non-spendable and we have spendable, okay? Now for the spendable, I've gone ahead and I've given you another mnemonic, which I call Racow. And Racow is this guy that I used to hang out with that was always spending all his money. So he's always, you know, wearing real fancy stuff, and he's always buying, you know, fancy cars and fancy, you know, you go out. It's a fun guy to hang out with because you go out and he pays for everything, right? Okay. His name was Racow. Okay. And so spendable, Racow, and then we list these things in terms of what? Most difficult to spend to easiest to spend. Okay, so two broad categories, what? Non-spendable, and then what? Spendable. And then for the spendable, we have subcategories under spendable, and that is remembered by the mnemonic Racow. Okay, and I'm going to go through these here now one by one. Okay, so let's first talk about non-spendable. Okay, non-spendable, is that difficult to spend, do you think? If it says
Probably
non-spendable?
difficult, yeah.
Very difficult, okay? And notice in this example, they give me what? They give me $55,000 of non-spendable, and they tell me it's what? For inventory. So I come back up, and when I look at my asset part, notice that inventory is 55,000. So what this classification of fund balance is telling you, which is like our retained earnings, this classification of fund balance is telling you some things cannot be spent like cash. So basically the things that are showing up in non-spendable are not cash and not receivables, because receivables will be cash pretty soon, right? But other types of assets like what? Like inventories, etc., are not going to be spendable. Prepaid insurance would be an asset, but it's what? Non-spendable, okay? For example, if you had, let's say you went to Costco and you got a 50-pound sack of nutmeg. They said, hey, $5, $10 for a 50-pound sack of nutmeg. And you say, are you kidding? $10 for a 50-pound sack of nutmeg? So you buy it, you get it home, it's 50 a pound, and then you're like, what am I going to do with 50 pounds of nutmeg, right? Nutmeg is you just put a little sprinkle on your eggnog once a year. Okay, now I got a 50-pound sack. So let's say you say, well, I know what I'm going to do. I'm going to put this nutmeg into a 10-pound, 5 10-pound sacks, and I'm going to go to Safeway, and I'm going to barter with Safeway and say, take the nutmeg, I'll take back some milk because I need milk. Safeway's going to say, got any cash? Got a credit card? Because you can charge on a credit card because you're going to be making money in the future. So you have a receivable, maybe a paycheck you haven't gotten yet, something like that. Because we are not interested in what? In trading your inventory for our inventory, right? So inventories, GASB tells us, hey, just list that as non-spendable. Prepaids, non-spendable, okay? Now you come over and you have these other categories now, which are spendable. And we're going to go through and understand the nature of these things that make up the spendable category, which is restricted, committed, assigned, and unassigned. Okay. So let's just go ahead and let's take a look first at the non-spendable. I've given you the example. Inventory and prepaids are the classic example of something that's non-spendable because it's not cash. It's money that's already been spent, right? Okay. Okay, good. Then we come to restricted. This goes in order of most difficult to spend. Now we're into the spendables, but these are, even though they're spendable, they're more difficult to spend than the bottom of RACAL, which is the U, which is the unassigned. Okay, so when we're talking about restricted, okay, it means that they are restricted by constitutional provisions or by enabling legislation, or they are imposed by, the restrictions imposed by individuals, entities outside of the government. Okay, let's talk about that one first. For example, bondholders, what happens? Often what the bond covenant will say, they ask you to buy government bonds. And they'll tell you in the bond covenant that these bonds are to be used to finance, and I always thought it was ridiculous, back in the 90s, kind of early 90s, I think, maybe late 80s, early 90s, they would have these bond initiatives and they would say, there was this whole tough on crime thing that was going on in the country. And they would say, do you approve of a 30-year bond to finance the construction of more prisons? And if you said you weren't in favor of that, that meant you weren't tough on crime, right? So everybody said, oh yes, go ahead and borrow money for 30 years to construct prisons. What kind of long-term investment is that? Let's see. We build prisons, right? And now we have this debt that we're going to have to pay in the future. So in order to, pay this debt, we have now put something on ourselves where we're going to have to, if you have prisons, what do you need to do with them? If you build
Create
a
a
big
school to
prison,
prison pipeline.
huh?
I said create a school to prison pipeline. Which is
Yeah, basically.
pretty aggressive statement, but I
You have
believe
to
it.
put people in them, right? And these prisons are run by, for-profit entities receiving money from the government. So we pay a debt service and we pay an operational, funding for a prison. Doesn't make a whole lot of sense. But anyway, what would happen? They say to the bondholders, we're going to only use this money to build a prison. Well, that money is restricted because you told bondholders that you're going to use it for a specific purpose. You told those outside of the government what the purpose of this money would be. That makes it restricted. Now, constitutional provision, you don't see too much of that where the constitutional provision will say money has to be used for a certain purpose. It's restricted. Let's talk about enabling legislation. Well, let's say that the government wants to start a new tax to fund, say, state disability insurance. And let's say there's some back and forth that says, well, we don't want to start this tax for state disability insurance, and then that money somehow goes and gets used for something else. So they'll pass a law that says they're going to tax you to fund the state disability insurance, but the same law that enables them to take that tax from your check also says it has to be used for funding the state disability insurance. So the enabling legislation would enable them to raise that revenue, also calls out restricting specifically how it should be used. And they're saying, hey, you can't spend that money any other way. And if you want to change that, what are you going to have to do? You're either going to have to amend the Constitution, or you're going to have to get the legislature to turn around and say, well, remember that tax that we were taking before that we told you we use for state disability? Now we're going to use it for this over here. Well, that gets very difficult to change that kind of a legislation. So they say, you know what? That money is restricted. Okay. Now that is contrasted over here with committed. With committed, now you still have the legislature. And when they say the highest decision-making authority in the government, when it comes to spending, legislatures are seen as the highest decision-making authority. Most people say, no, it's the governor, it's the president. No, when it comes to spending money, the power of the purse goes with the legislature. So when they say the highest decision-making authority in the government, they mean the legislature has voted as to the use of money that was already available to that government. So let's say you have a school district, and let's say the school district is saying, we're going to have to cut out team sports, school sports, because we just don't have the funding for it. And then somebody says, well, wait a minute, why don't we take the revenue that we've been getting from football tickets, high school football game tickets, and let's use that to fund school sports. Now, it was money that they already had, but now the school board, the legislature, has voted that that money will be earmarked or set aside for school sports. That money is committed. And you say, but John, you just told me that the legislature could also, through enabling legislation, cause money to be restricted. The difference between these two examples, that in the case of the restricted money, it was what? Enabling legislation. The same legislation that allowed them to get the money to begin with called out how it should be used. For what? For committed, it was money that they already had that they now have earmarked for a specific purpose. We consider that money to be committed. Question? Okay. So subtle difference there, okay? And if you're sitting there saying, well, geez, you know, who cares? Apparently GASB cares. And apparently when they're sitting around with their brandy snifters or something, they decided that this was an important designation that needed to be called out as we talk about fund balance, okay? So far we have what? We have restricted, right? We have committed. Now let's go to the A in Raquel. Let's talk about assigned. Okay, and of course we have non-spendable too. Let's talk about assigned. For assigned now, it has been the city managers that have taken money that's available to them, and now they're starting to call out specifics as to how that money is going to be used. So what happens? Money goes to a school district for education. And they say, okay, how are we going to spend that money on education? And they decide that they can spend some of the money on education to put in solar panels in the school. We're going to put solar panels in the school, and we're using that money for education because the solar panels will allow us to keep the lights on. So then something happens, and they say, you know, all the history books are wrong. We had a batch of history books that said that Fred Flintstone discovered America. We need to change that so that it reflects more of the nuance of whoever discovered America, whatever, right? So they want to change all the textbooks. All the textbooks need to be changed. So the city managers, the school managers in that case, could decide to do what? Reprogram that money that was going to be spent for solar panels that fit under the bubble of education, but now instead of spending it on solar panels, we're going to spend it on history books. So when the city managers, when the managers of that fund have the ability to do what? Move that money around, and they have gone ahead and put it on something like the solar panels, they call that money assigned. It is not what? Not restricted, not committed, because it is easier for them to do what? Change their spending decision. But they have made a spending decision, so they want to call it assigned. They don't want to call it the U in Raquel, which is unassigned. Unassigned means that there has been no constraint put on that money. It can be spent for anything within the purview of that government's charter. Okay, they can't just sit here and say, gee, the money's unassigned and we're sitting here, we got all this unassigned money, let's go to Vegas. Okay, no, it doesn't work that way. They still have to spend it within their fiduciary charter, but they can spend it however they like in accomplishing that fiduciary charter. That money is considered unassigned. Okay. Now, what I want to do is go through this example that I wrote here on these slides. Okay. And I'm assuming a capital project fund. Is that one of our governmental funds? It's the what? It's the first P in grasp. So we're talking about a governmental fund, our capital project fund. And we have this capital project fund that is going to build a county courthouse, let's say. And I know, humor me guys, I know you can't build a county courthouse for $200,000, but let's say they go ahead, or maybe a real small county courthouse, one about this big, we're going to build it for $200,000. And so we issue the bonds to get the money. So we get some cash. We have $200,000 of bonds, right? And then let's say we had some inventory just available for this particular capital project. I don't know, maybe we have some tiles that we can use, and those tiles are worth, and I know all these numbers are grossly understated for some project like this, but let's say we have some tiles that are in the form of inventory for $20,000. Now let's say the law says, well, the bond covenant says, first let's go to the bond covenant, the reason we got this $200,000, it says that this money can only be spent on hard costs. And sometimes they'll write the bond covenant that way because over the years they found that if you don't specify that, then here comes people to the public trough and they say, well, let's take a trip to Europe to study courthouses. And by the time you get done, there's no money left to actually build the courthouse because everybody came and, you know, graft and corruption and used up the money. So they say, no, it's got to be used for hard costs. It's got to be things like drawing blueprints, building the foundation, building the building, that kind of thing. But we can't get started until we do an environmental impact study, let's say. Okay, and often that's the case. You're gonna build a courthouse over here, you got to figure out how it's going to affect the traffic patterns, the environment, so on, right? And so what happens? They sit there and they say, well, geez, we can't pay for the environmental study out of this $200,000 because that's not considered a hard cost, but we can't get started until we go ahead and order the environmental impact study. So they go ahead and order it. And the environmental company does the study and bills the capital project fund $30,000. Okay. So what do we have? We have cash at 200,000. We've got inventory of 20, and we've got this liability of 30. Now remember, assets equal liabilities plus our fund balance. And how are we going to call out that fund balance? So we would have what? We'd have non-spendable fund balance of 20,000. That's the inventory. We'd have restricted 200,000. That's because we've got this money that is restricted for hard costs on this project. And then we've got what? This 30,000 in the form of a negative number. It's unassigned because we don't know at this point where we're going to get the funds for this. Now, a lot of times students will say, well, what happened then? What did they do? Well, probably our friend, the general fund, will eventually send the money over necessary to pay this bill at the time it comes due. The point of this example is to show us what? Is to show us how we would list our fund balance based on the nature of the spendable nature of these resources we have. Question?
Hi, Professor.
Yeah.
Sorry, go ahead.
Thanks, Danny. So the only unassigned balance is the 30,000. The rest of it is not unassigned.
Well, correct. The rest of it is not unassigned. And more specifically, it's non-spendable and restricted.
Correct. Okay. Thank you.
Yeah.
And what is CPF? I just missed that. part.
Capital project fund.
Thank you.
I guess the first P in grasp. Capital project fund, permanent fund.
And what does FB stands for?
FB stands for fund balance.
Okay, thank you.
That's our fund balance, and then I just got the categories. And you don't have to have all the categories, guys. Generally, governments do, but I didn't want this example was just to sort of give you a general sense of what's going on here.
So every dollar in these retained earnings is put in one of these categories?
Yes.
Wow.
Oh, I just have a kind of like an exam, maybe questions. So I know that these are the all the different types of not types of fund, but
Categories.
categories, types of fund balance. What's the best way to maybe understand and study all of this and kind of remember? Because as you just talk about it, I kind of forget a lot of them already. So I was wondering.
Well, first off, would be to understand RECAL. Restricted, committed, assigned, unassigned. With me so far? Two categories, non-spendable, spendable, spendable RECAL. Picture somebody wearing all kinds of jewelry and stuff named RECAL. Restricted, committed, assigned, unassigned. I've heard people call this new car. I don't like that because that doesn't list them in order of how easy they are to spend versus how hard they are to spend. So my mnemonic is so dumb, it's easy to remember. That's my talent for mnemonics. I make them so stupid that you can remember them. Okay, so we're not spendable, RECAL, restricted, committed, assigned, unassigned. That's number one. We know that what? Non-spendable is things like inventory and prepaids, right? Because you can't spend them like cash, right?
Right.
Okay, so then we have to deal with the spendable. Restricted is either a bond covenant, right? Or it's going to be what? Restricted by enabling legislation. Bond covenant says, I'm going to spend this money on prisons. Then you can only spend it on prisons. And you have that covenant with those outside of the government. You've told people who took their paycheck and bought a bond from you how you're going to use it. Well, you can't then say, well, you know that bond contract that I signed with you? Well, never mind. I'm going to take the money that you bought to finance a bond, to finance construction of a prison, and I'm going to use it to construct a new stadium. What? No, you can't do that. Okay, a bond is a legal contract. You tell somebody how you're going to spend the money, then you have to spend it that way. Unless it's a general obligation bond, but then that money wouldn't be restricted. It's where the bond covenant is called out how that money is supposed to be spent. Enabling legislation, the same legislation that the legislators went out on a limb and voted that we will raise a tax. It's a new tax. I mean, how afraid are governments to raise taxes nowadays? It's a new tax that we voted for that we're telling you we're going to use it for SDI disability insurance. Okay, well, maybe a legislator can feel comfortable voting for something like that because, we all agree that if someone is injured, the government should help them out to kind of get them back on their feet. So that money that we took from taxpayers' paychecks, we told them in the bill that we passed to get that money, we told them how we're going to use it. Well, that money is considered restricted because now you're going to have to go back to the legislature and ask them to keep that money, but decide to use it for some other purpose. Politically, that gets almost impossible. So GASB says, yeah, that money's restricted. That is different than what? Committed. Again, it's the legislature, state legislature, Congress, whatever, voting how they're going to use that money. And we know how difficult it is to get legislatures these days to agree to anything. But now the money is not money that was raised by this process. It was money they already had that now they're earmarking for this particular purpose. So in both cases, what? where the legislature is involved, the bond constraint restricted, you can remember that. Where the legislature gets involved, you're going to be looking for the phrase enabling legislation, where that makes it restricted. Here, the legislature is involved, but you're not seeing the words enabling legislation. They have earmarked, they have voted to use that money a certain way. For assigned, you're seeing that the city employees, in exercising their fiduciary responsibility, have decided to put some money aside for some purpose, and they're telling you that. And then when you get down to unassigned, unassigned is basically saying this money can be spent however within their fiduciary responsibility. Again, they can't spend it at the racetrack, but for the unassigned, the key things is only the general fund can have a positive unassigned. They're saying that because all of the other funds, capital project fund, debt service fund, they're a fund that is not general. They have a special purpose, so any money they get is attached to that particular purpose. So there is no just money that can just be transferred around, whereas the general fund has general resources and they can transfer it. Like in this example, I was saying probably the general fund would transfer 30,000 to the capital project fund. Okay, so only the general fund can have a positive unassigned. All other funds would have to have a negative unassigned. So I know it sounds like I repeated the same thing I said in response to your question about how to remember it.
It's actually
There are some things in this world that's what you have to do to remember it.
Got it.
Professor,
Yeah.
on the same note as Danny, I know we were talking about the Becker earlier, but do you recommend a module within Becker that goes over those different fund balances? Because practice, usually always helps with getting to know
Yeah,
what goes where.
and I've got the book there for you, right? So it would probably be helpful if I gave you a sense of the module. So it's chapter 9. I'll write it down here.
I'm actually on that chapter right now, and it's just the Becker one. I guess it's so summarized in a way that
Yeah, it's kind of set up differently than how you're explaining it, I guess.
yeah.
Well, I don't know exactly what to say about that other than unlike Becker, I just talked to you about it for a half hour. It's chapter 9, module, is it module 3?
I think module 3 is transactions and
Module
events.
4.
Okay.
Module 4. Module 4, section 3 or whatever. They start talking about it there, and yeah, they're talking to you about it a little bit differently than what we have here. But I'm not trying to repeat. I'm not going to read the book to you.
Right. No, I get
yeah,
it.
you know. So I think it still has the same things, and I feel like I actually gave you examples. I think there they just list out some things there, whereas I went ahead and gave you some examples.
Yeah, you're much better than the book.
Yeah, but I'll tell you what, let's do this, because what I don't want you to do is worry about this, because I'm not going to come into the exam guys asking 52 questions about categories of fund balance. Okay. So
Can I ask another question before we move on?
Okay.
For the can you go back to the previous page?
Yeah.
For the so for unassigned 30,000, it's a liability, but on the balance sheet, does it go to the fund balance section rather than the liability section?
Both. It's a balance sheet. So it would have cash, 200,000, inventory, 20,000, and then this liability of 30. Then you come down to fund balance, non-spendable is 20,000, that matches with the inventory. The cash is all restricted and the unassigned is 30. It's a balance sheet. So 220 minus 30 equals 220 minus 30, right?
So this unassigned 30,000 will go to the fund balance section at the very end of the balance sheet.
Yeah, but it also, I just want to make sure we're clear, it also shows the liability, right? 220,000 is that total there for the assets, right?
Mhm.
And then when you add up the assets plus liabilities, it's 220,000, right?
Oh, okay, okay. I think I got it. Thank you so
For the
much.
balance sheet, yeah. Okay. Okay, now let's look here, okay, because I think this is probably gonna be a good exercise. It'll take away some of the fear here. And there were some other ones here. I just picked out the ones that were relevant to this classification of fund balance. So we have the fire station capital project fund has been funded by a bond issue. Stop. Do I need to read any more? The covenants of the bond issue limit. It's a bond issue. We saw the key word there, bond issue. It is what? Restricted, right? Okay.
Restricted.
Okay, good. The city maintenance capital project fund has been funded by monies set aside by the city council. Notice here, guys, they don't say anything about enabling legislation, constitutional. It's money set aside, which is key words that tell you that what? It was money they already had that they have now earmarked, set aside for a particular purpose. That money is committed, right? Okay. And then the city library debt service fund accumulates money to meet the debt service requirements of the elements of the library debt. The covenant of the bond issue, well, if it's a covenant bond issue, that money is what? Is restricted. So again, those key words that I pointed to in those descriptions are what you're looking for to determine whether money should be considered restricted, committed, whatever. Okay. Okay, good. Let's look
Good.
at this.
Professor, is it all right if we spend a little more time on number 5, the
Yeah.
city maintenance, city council? Okay. Earlier, when we were talking about the categories, we wrote that city managers can assign funds.
Yeah,
I thought the legislature committed funds,
they do.
but the city council can also commit funds.
Are you messing with me? You said the same thing twice or did I? Did you say to me that the city council can commit funds?
Yes, that's what I believe based on like number 5 here, right?
Right.
But
So who else were you thinking could commit funds besides the city council?
the legislature?
Well, the city council is the legislature in the city.
Okay, I thought we were talking about the legislature of a higher order government. Okay,
Yeah.
thank you. So
Yeah.
then
When they
what's the
say
difference?
the highest decision-making authority, they mean in that government. And again, sometimes people say, well, wait a minute, the mayor is the highest decision-making authority. No, not when it comes to spending money. It's the city council in the city. So at the state level, it's what, the legislature, they often call it. They don't talk about federal accounting in this class, but for the federal government, it's the Congress. So you got Congress at the federal level, legislature at the state level, although that's not, they got 50 states, right? They can call it different things. And then city council is at the city level.
Okay, and they're elected officials and not employees, and that's what makes them
Correct.
able to
Yes.
commit. And
Yeah,
set
that's
aside.
probably, thank you. Yeah, that's probably good. Elected officials, not employees.
Thanks for
Correct.
helping me work that out.
Yeah, if it's employees, then it's going to be assigned. If employees decide, hey, we're going to use this money for this purpose, it's assigned, because as employees, they're tasked, with living within the law, but then, it says spend this money on education. Well, that could mean a lot of things, right? But once they've made a decision, well, we're going to spend it on this part of education, then they're telling you that money is assigned. Okay. Let's look at this one. General fund resources that are limited to use by constraints imposed by law through constitutional or, there we go, keywords, enabling legislation. That money is what? Restricted. Okay. All right, guys, I want to move on. So I want to move on, and then here comes another graphic here that only the general fund can have a positive unassigned. Everyone else's is negative. And we saw how the capital project fund in that quick little example had a unassigned. Had a negative unassigned. Okay. All right. I want to move on because this is one of these things you're just gonna have to look at a couple times to fully get comfortable with. It's no, like I said, nobody wakes up in the morning and says, oh, okay, yeah, that's clearly an unassigned amount. And again, GASB got in and got a little nerdy about this. I just want you to be aware of the different categories and be able to answer some fairly straightforward questions like what we just looked at, okay? All right, good. With all that, then what I want to do, I think, is take a quick break because I feel like we're overheating a little bit. So we're going to look at our operating statement for our governmental funds next, the statement of revenues, expenditures, and change in fund balance. Okay, so we'll look at that here when we get back. We'll take a 10-minute break. We'll come back at, let's make it 3:25. I'll give you an 11-minute break. Okay?
Yeah, Professor?
Yes.
I was just curious when we're planning on hitting the nonprofit portion of our class.
I think the syllabus has it there towards the end. Should be on the syllabus.
Okay, gotcha.
Get into chapter 14.
Okay, so I'm guessing governmental accounting is more complex compared to nonprofit. Yes, it is. And when we're talking about governmental accounting, think of it this way. I'm showing you the entire set of standards. Well, I'm not showing the entire set of standards because we'd be here for the rest of our lives, but we're having a class that is an overview of standards that are issued by the Governmental Accounting Standards Board, right? When you get to the not-for-profit, we're talking about, one section of the entire codification of the FASB standards, right? So that's why we can cover that in a couple of sessions because it's not a whole set of standards, conceptual framework. This is what you're supposed to have. This is the NDNA. Whereas here we're talking about everything that GASB has called out for state and local government. When I say everything, we're obviously at a higher level, but still we got to cover the main points of an entire set of standards. Okay, cool. And if you post that Becker schedule, I'd take a look at it. Or sorry, the CPA study schedule.
Yeah, if you don't mind, yeah, it's my own. It's not Becker's because Becker never really comes right out and tells you what you should do. Whereas I'm kind of, more like the coach that says you're going to take 300 reps before you're ready for this. So yeah, if you send me an email, if you don't mind, you can send it right now or when you get a second. And then I'll remember because sometimes those things slip through the cracks on me. But yeah, I'll send them.
Okay, I'll send you an email then.
Okay, appreciate it. Okay, good.
So now we're going to turn to the operating statement, the income statement for our governmental funds. So we call that statement the statement of revenues, expenditures, and changes in fund balance. We saw that. Remember, I had the slide with the red titles for the two statements, the balance sheet, the balance, which is like the balance sheet, the statement of revenues, expenditures, and change in fund balance, which is like the income statement. We took a look at some of the key aspects of the balance sheet. Now let's look at some of the key elements that constitute the statement of revenues, expenditures, and change in fund balance, the income statement. Okay, so we have revenues and other financing sources, and we have expenditures and other financing uses. Now, oh, come on. Really? Are you really going to do this to me right now? Hang on a sec, guys. Sorry. Okay, 1 second, guys. Sometimes it likes to do things to me here. And okay, good. It's back. See, sometimes I don't know why it's doing that. Okay. Okay. So let's go ahead and distinguish between our revenues and our expenditures and our other financing sources and other financing uses. Okay. So revenues are things like our tax dollars that come into a government, right? Revenue is really a normal course of business. And for a government, taxing and collecting taxes is sort of a normal course of business, just like for, you know, a company like Nordstrom, revenue comes from selling clothes or something, right? Normal course of business, okay? Expenditures are normal course of money that is spent by a government. For example, buying a fire truck is an expenditure that's normal course of business. So since since fund balance is like retained earnings and revenues increase retained earnings, then it makes sense to us that revenues do what? Increase fund balance, okay? Since fund balance is like retained earnings and what? And expenses would decrease our retained earnings, then it makes sense that expenditures will do what? Will have an effect of decreasing fund balance. Any question on that? So revenues increase fund balance, expenditures do what? Decrease fund balance. Now, we have other financing sources and other financing uses. These are like non-operating things. So other financing sources are like non-operating revenue. Other financing uses are like non-operating expenses. In other words, they're not in the normal course of business for a government. And we're going to start to talk about what some of these are, but let's talk about proceeds from long-term debt. Okay. Now you look at that and you say, okay, you get cash when you issue a bond. You get cash when you issue a bond. So you debit cash. You can't credit what? You can't credit long-term debt, bond payable, because we don't have any long-term debts in government. So what are you going to credit? Well, in government, you do this weird thing under modified accrual accounting in which you credit other financing sources. You treat the issuance of debt like a non-operating revenue. It's a little bit different, a little bit weird, but we got to credit something. We can't credit long-term debt. So we credit other financing sources. We report that on the income statement, on the statement of revenues, expenditures, and change in fund balance. And other financing sources have an effect of increasing my fund balance, because again, fund balance is like retained earnings. Non-operating revenue would increase retained earnings, so it makes sense that other financing sources, which is like a non-operating revenue, would increase my fund balance. Now, there's other financing uses. Other financing uses are like non-operating expenses, but we don't call them that. We call them other financing uses. And they have the effect of decreasing fund balance. An example of another financing use is when one fund transfers money out to another fund. Go back to our little example of the 30,000 that was needed for that environmental study. When the general fund transfers, say, that 30,000 to the capital project fund, the general fund will credit cash because cash is coming out, and it'll debit, and it doesn't debit non-operating expenses. They don't have those. It debits other financing use and reports that down on the statement of revenues, expenditures, and change in fund balance as a other financing use transfer out, because that money is coming out of the general fund. The capital project fund, the money's coming in. So the capital project fund would debit cash when they receive that cash, and they're going to credit other financing sources transfer in. So main thing here is for us to first understand that revenues increase fund balance and our expenses decrease fund balance. Our other financing uses do what? Decrease fund balance. Other financing sources do what? They increase fund balance. Number one thing you want to take from this slide. The other thing from this slide is you want to understand what are the examples of other financing sources, other financing uses. There are only two other financing sources. There are only two other financing sources: transfers in and long-term debt proceeds. That's it, guys. Because you hear me talking about all this and you think there's 50 things that could constitute another financing source. There's two: transfers in and other long-term debt proceeds are the only type of other financing source. There's only one other financing use, and it is transfer out. Okay, so let me take a look, because I thought
if you're doing a transfer out or transfer in, you have to do two journal entries then, correct?
Yeah, let's go ahead and let's just sort of walk through that.
Okay.
When I'm going to put it here before I unfurl the rest of this slide. So you might want to write it down in the margin somewhere, because I'm going to just write it across the middle. So let's go back to that idea of the 30,000 that was being transferred out of the general fund. Don't want the pen for this. So it's money that is basically coming out of the general fund and into the capital project fund. Okay, and it's 30,000. Okay, so in the general fund, and I'm going to ask you to play along with me here a little bit. If money's coming out of the general fund, should I debit cash or credit cash? Good. Good. So I'm going to credit cash for 30,000. Excellent. Okay. Now I don't debit expenditure because they want me to call that sort of not a normal course of business thing. They want me to call that other financing use, OFU, right? What do you say to somebody when they say something you don't like? OFU, get out of my face, right? Okay. So other financing uses, transfer out. Sorry Sorry, guys, I gotta get my debits and credits lined up right. Debit on the left, credit on the right, right? With me so far?
Yes.
Okay. On the capital project fund side, they're getting the cash, right? So they will go ahead and they will debit cash for 30,000. They will credit, and I'm going to abbreviate it, guys, OFS, other financing source, transfer in, and they're going to credit that for 30,000. Squeeze that in. That says credit for 30,000. So yes, that's a long way of answering your good question, which is what a transfer is another financing use on one side, and it is a what? Other financing source transfer in on the other side, the receiving fund. Question?
So just for like conceptual understanding of it, for the general fund, there's one book, and for a capital project fund, there's another book that you're recording these transactions.
Each fund is a self-balancing set of accounts.
Okay, cool. Thank you.
Yeah. So you have a balance sheet and an income statement for your, we don't call it an income statement, we call it statement of revenues, expenditures, and change in fund balance. But there's a balance sheet and an income statement for the general fund, debt service fund, capital project fund, permanent fund, and special revenue fund. Each one of them has their own set of financial statements. Yes. In fact, let's just do this. Let's say before this transaction, the general fund had cash of 30 and fund balance, and I'll say it was unrestricted, whatever, of 30,000, right? I don't care what the category of it was. Let's not get into that for this example, right? That's the balance sheet before. Okay. Then they'll report on the statement of revenues, expenditures, and changes in fund balance, which is like the income statement, right? They will have revenue of 0. They'll have expenses of 0, but they'll have an other financing use transfer out of 30,000. So the change in fund balance for the period will be like a loss, a negative 30,000, right? Then what they'll do is they need to, just like any income statement, you have to close your proprietary accounts. You close the income statement accounts. So they will have to do what? To close this other financing use, since they debited it, to close it, they'll have to do what? They'll have to credit other financing use. And guys, I'm still in the general fund here. They'll have to sit here and debit other financing use, whatever. If we were in the room, picture me eloquently writing this on different whiteboards. Okay, we would debit other financing use, transfer out, and I mean, not debit it. We debited it where? We debited it here, right? To close it, I have to credit it. Got to close all your income statement accounts, right? So to credit that, to close that, I have to credit it. And I have to debit what? Fund balance, right? We don't call it, we don't have income summary. So we just go ahead and debit it straight to fund balance. And when I do, now, when I prepared the balance sheet, immediately after my closing entries, my cash is what? My cash is 0. I didn't have any liabilities in this example. They continue to be 0. And now my fund balance is how much? Fund balance is 0, right? Because I closed it right here. I assume that silence means this is such a beautiful example. You're just all, you're speechless by this example right now.
I think I might have to rewatch this on YouTube
Why?
because I got lost in the midway.
Ow.
I'm sorry, Professor.
How can you get lost? Look, here's the balance sheet before anything. I make this one journal entry in the general fund. I debit other financing use. I credit cash, right?
Right.
Okay, when you credit cash, does your cash go to 0?
That's right.
Okay, so we know the cash has to be 0, right? Now I prepare financial statements just from that one entry. So revenue is 0. Don't use your imagination. It's just this one entry. Revenue is 0, expenses are 0, and other financing use transfer out is an amount, the subject of this part of the lecture, is an amount that's showing on the statement of revenues, expenditures, and changes in fund balance, right?
Right, which is negative, right? Okay.
Well, it's a debit, and so it's a subtract. Revenues are credits, expenses are debits, other financing use is like a debit. Transfer in other financing sources is like a revenue, so it's a credit, right?
Right.
Okay, so if you have expenses, you show them as a subtract on the income statement, don't you? Against revenue?
Yes.
On an income statement,
Right.
right?
Yes. Understand.
Okay, all right, good. Now, in commercial, when you prepare an income statement, don't you have to close your revenue, your expense, your other non-operating revenue expense counts? Don't you have to close them?
Yes, at the end of the month, right?
End of the month, end of the year, whatever. Okay, so here that's all I did. I just closed it, and I closed it by crediting it, right?
Okay.
Now it's 0. I have to debit something. We don't have income summary, and so what? Income summary eventually gets closed to retained earnings, doesn't it? So since fund balance is like retained earnings, I just take that debit straight to fund balance, right?
Right.
Fund balance was 30,000. Fund balance is like retained earnings, so it's like a credit. Maybe that's what you might be missing. So when I debit it, it goes to 0, doesn't it?
So
Fund balance has a credit balance in it. It's like retained earnings. Therefore, it has a credit balance, right?
right.
When it was right here. And when I
Right.
debited this zeroes it out to 0, right?
Okay. Okay. I got it. I thought it
And
was
that's how I came up with this now closed balance sheet
okay. Okay. Got it.
after the closing entries, whatever. It's okay. I know
Thank you.
sometimes I act like an ass and I can't help it. It's because I am an ass.
No, Professor.
I've looked
Thank
at
you.
these things for so long, guys. Sometimes it's hard, but the main thing is I don't want to leave when you're this close to the understanding and then you say, oh, I'll look at it on YouTube. I get worried because then when you look back at YouTube, you're even further from the understanding. So I want to grab you while you're before, it's easier to pull you on board when you're kind of almost there than if you're starting all over again. Now, in the capital project fund now, I've got to have these amounts come in now. So let's just see what we can do in the capital project fund. See, put it back in slideshow. So in the capital project fund now, of course, the money's coming in, right? So they'll debit cash for 30,000. And credit other financing sources transfer in for 30,000. Okay. Now, I'm going to assume that before we make that entry, we'll do the before and after shot. Before we did that journal entry, cash was 0, fund balance was 0, right? Okay. And then when the money comes in, we debit cash, credit, other financing sources. So now we can make our statement of revenues, expenditures, change in fund balance, right? Which is like the income statement. Revenue is 0. Expenditures are 0, right? But now we have what? An other financing source. We have a transfer in for 30,000. And now we have a change in fund balance. And as I was saying, when we started this thing, other financing uses decrease fund balance, other financing sources increase fund balance. So I have a positive change in fund balance. Then when I do my closing entries, I'm going to do what? I want to close this. So I go ahead and I debit it to close it. It's like an expenditure, but I call it other financing sources. It's like a revenue, excuse me, but I call it other financing sources. I debit, transfer in to close it. And I go ahead and I credit fund balance to put that into fund balance. And now when I do my after balance sheet, after the closing, cash is what? Cash is 30, started at 0, but I debit, I'm not going to tee these up, but I debited it for 30. So the cash is 30. Fund balance, right? It started out at 0. It's a credit balance, right? So after having closed that, I credited fund balance for 30 and my balance sheet balances. Okay. Question? Okay, so again, when you look at these, when you look at all this, why? Okay, there it goes. It's fine now. Calm down, John. Okay, so now let's go back through the whole thing again. So when we're talking about our statement of revenues, expenditures, and change in fund balance, which is like the income statement, we have revenues, we have expenditures. Revenue and expenditures are really considered like normal course of business items. Revenues increase fund balance, just like revenues increase retained earnings, right? Expenditures decrease fund balance, just like expenditures decrease retained earnings. Then we have these sort of non-operating things, but we don't call them that. We call them other financing sources and uses. Other financing sources increase fund balance, and there's only 2 of them. The bond proceeds, and you can kind of see the example of the journal entry there for the bond proceeds, debit cash, credit other financing source, bond proceeds. It's like a non-operating revenue. You credit it when it increases and transfer in. And you saw the example on that second slide. I wrote in that example. We credited the 30,000 for other financing source in the capital project fund. Other financing, so there's only 2 other financing sources. There's only 2. I'm going to say it again. There's only 2, because I think sometimes students' minds start to spin on this because they're hearing all this and it sounds like I'm saying 50 things and I'm only saying 2 things. There's only 2 other financing sources: long-term debt proceeds and other financing sources that transfer in. Okay. For our other financing uses, that decreases fund balance. It's like a non-operating expense, but I don't call it that. I call it other financing use. And there's only one, the transfer out. It decreases fund balance, like we saw in the example here when we were doing it for the general fund. Question? Okay, good. All right, so that's good understanding. You get that kind of stuff down. That's the kind of stuff that could be a little tougher, could stumble you a little bit. So make sure you're comfortable with that. Okay, good. Statement of revenues, expenditures, and change in fund balance for my governmental funds. For example, my general fund. Revenues. Here we're back to the more traditional format for an income statement, unlike what we saw at the government-wide level for the statement of activities. At the governmental fund level, we're back to revenues on top, then come our expenditures. Notice, though, we still call our expenditures out by program. So notice we're calling it out by public safety, okay? Now what? We then have the difference between our revenue and expenditures, and we call that excess or deficiency of revenues over expenditures. Here they had an excess of revenues over expenditures, okay? So this is very much like a what? This number right here is very much like operating income would be on a commercial income statement. Commercial income statement would do what? Would have your sales. Who wants to jump in on this? Then what would you have? Cost of goods sold. Then you'd have what?
Gross profit.
Good. Then you'd have, well, I'm not going to get into every single operating expense, but you would have operating expenses, right?
That's right.
That would be listed. And yeah, you could, you know, FASB doesn't really get up in your face and say you have to report selling, general and administrative information. Companies just start to do this. Okay, what FASB says to you is more this sort of general format of the multiple step income statement. We have our operating expenses, and then we have what? Operating
income.
Good, right? And then you start to have non-operating items, don't you?
Yes.
Non-operating items. That says non-operating. I'm done trying. Like gains and losses on equipment, sale of equipment. We put gains and losses together. We call that GALE. Okay, gains and losses, whatever. Okay, and then you have net income. Right? Okay, just a quick review. Well, right here, there's our revenue, there's our expenditures, and then we have what? And then we have this item, excess of revenue over expenditures, and we had what? More revenue than expenditure, so it was a positive number. But that's like operating income because it's revenue minus, we call it expenditures here, right? And then you continue on. The next slide is a continue on. Then you have like the non-operating section, but we don't call it that. We call it other financing sources and uses. There are two other financing sources: long-term debt proceeds and what? Transfers in. There is one other financing use, which is what? Transfer out. We bring those into the equation. Sometimes we might want to call out a special item. I'm not going to get too much off into that at this point. Okay, but we have the net change in fund balance, which is called change in fund balance, but it's like net income. Then, just like you do in a commercial version, you have your beginning balance for your retained earnings plus your net income minus your dividend ending balance. Well, we don't have a separate statement of retained earnings. We just stick it right here at the bottom of the income statement of revenues, expenditures, and fund balance. We show you the beginning balance, add the net income, gives you the ending balance, but we call it change in fund balance. Question. Now, when you look back at the expenditures, guys, let's just look back at the expenditures for a minute. Notice that they do tell us where we can figure out the nature of the expenditures. So current, and this is what they call a character designation, current tells us this is money we spent to benefit just the current period. If it says capital outlay, even though it's treated as an expenditure on the income statement, we tell you that that money was being spent for what? Was being spent for a capital item. So you can still tell, even though we're calling it expenditure, the nature, the character of that expenditure was for a capital item. Question? And that's what we start to do here, is put some definition on some of those labels we put on expenditures. So of course, we categorize them by fund, okay? And then we start calling out, let me just go back. We start calling out the different functions and programs, okay? Which is very similar to what you saw at the government-wide level, similar functions and programs. The main difference is, of course, down here, we're using modified accrual versus we're using accrual at the government-wide level, but the labels aren't that different. And then we start talking about programs. Programs are things governments do. Governments keep you safe, or at least they try. So public safety is a good example of a government function program. To carry out programs, you have organizational units. So to carry out the public safety function, we have the organizational unit fire, we have the organizational unit police. Okay. Then what? Then we have activities. For the fire department, it might be building inspection, where they go and make sure that the building is meeting the fire code, all the exits or, fire exits. There was one example where the San Francisco Housing Authority, because they're having trouble with crime, locked the fire exits. What happens if you lock fire exits? What's the next thing that happens the day after you lock them?
Oh, you get fined.
There's a fire. No, there's a fire.
I'm just kidding.
They locked the fire exits, and then there was a fire. I don't know if it was the next day, and a bunch of people got killed, and they got sued, and they almost went bankrupt as a result, right? So you don't lock fire exits, and who knows where the fire department was, okay? So what happens? That kind of stuff happens. If you're the police department, you got to do patrols. I have a friend that used to work for the city of San Jose in the police department, and we'd be sitting on a Sunday watching football, having a good time. All of a sudden, this pall of depression would come over him. He'd just go, what? Monday, I got to do patrols. What's that? I got to go to the hotels where maybe people aren't supposed to, that are wanted or hanging out. And I got to run all the license plates. And then if I get a hit on a license plate, now I got to call in a whole group, and we got to find out what room they're in and pound on the door and remove them and take them. And it's horrible. Okay. So this is a activity carried out by the organizational unit police under the public safety function, right? Okay. Then what? Character tells us the period of benefit. If it says current, what period do you think it'll benefit? The current period, right? If it says capital outlay, then it's probably going to benefit a little bit the current period, but hey, we can use that snow plow, right? We bought some machinery, maybe we can use that for the next 10 years or something. Debt service. What responsible organizations try to do is they try not to borrow money for current operating period. You could, but that should be fairly infrequent. If you're going to borrow money for a longer term purpose, it should be matched with some benefit that's going to extend over several periods, right? You paid for something on credit, you should get that benefit, and you're going to pay it back over a longer period of time. You should get some benefit over that longer period of time. Okay, so debt service could also be something that would be seen as to benefit the future and current period. Okay, object class, you could break down your financial statement to the level where you're calling out things like salaries. So these are simply labels that you can put on your expenditures. Now we go over to this next slide and they start giving these long definitions. Just remember my examples, okay? Much easier to understand what's going on than this sort of hard to understand esoteric description of what these different things are. Okay? This is nonsense. I put this slide in here just so you can see this dual effect thing, okay? Just so you can see how the same transaction, purchasing of equipment, would be treated differently if it was in, say, the general fund versus being reported for a governmental activities column at the government-wide level. So money spent on a building is treated as an expenditure at the government-wide level, and then would be treated as an asset, a long-term asset at the governmental fund level. It's an expenditure, say this right, John. At the government-wide level is treated as an asset. Now, again, they sort of show you these entries side by side as though a company would be doing one thing at the government-wide level and something else at the fund level. The reality is during the year, they would simply make this transaction. And then when they go to do their consolidation to the government-wide level, they would make consolidating and converting journal entries. So what journal entry would you want to make if you started with this 2A here? What journal entry would you make to convert the fund statement to a government-wide statement?
You would
Right.
you would credit expenditures, capital outlay, and then you would debit buildings.
Good. I'm going to credit expenditure for what, the 400,000, and debit building, right? And that's going to be done on a worksheet. And then I'll pull those worksheet entries over so that on the far right column of the worksheet, I would have now a set of consolidated statements, and then I would be able to report everything at the fund level, report everything at the government-wide level, because one side uses modified accrual, the other side would use full accrual. Good. Okay. Okay, good. So here's some more. We borrowed some money and it's a 3-year note. Since it's 3-year note, it is what? It is a longer term debt. We don't have long-term debt on our governmental fund financial statement on the balance sheet, right? Therefore, we would report it as another financing source. And then when we get, if we were trying to report that same transaction at the government-wide level, now we would need to do what? Credit note payable, because we do report non-current liabilities at the government-wide level. Question? Again, you make the journal entries at this level and then you convert, making a journal entry to convert the fund level to the government-wide level. But there could be instances where I'll give you a question and I'll say, to record this in the government-wide statements, what would be the journal entry? This would be the answer. To report this in the fund of financial statements, say the general fund, this would be the answer. Okay. Okay, some things about these funds. General fund, one per government. Okay, so even though they call it a fund type, there's only one general fund. Okay, and this is where we report most of the government's operating activities. Special revenue fund. I've given you the example of a road fund where we have revenue coming in, say through a gas tax for a specific purpose, and then that money is spent on things like road maintenance, road improvement. Okay, very similar to the general fund. We have the debt service fund. Debt service fund's whole job is to accumulate resources that will then be used to pay back the principal and interest on debt. And we'll talk about that more in chapter 6. Okay. Capital Project Fund keeps track of resources that are accumulated to be used for what? For a capital project. So the money coming in is the revenue, the other financing sources. The money being used is the expenditures, and we account for all that in the capital project fund. Okay. Permanent fund, I'm not sure what this picture represents here. Permanent fund is money in which we will spend the interest earned on amounts that are permanently, that's the term permanent fund, that are permanently held by the permanent fund. So let's say we want to have a park in the city, and some rich person says, well, here's $1 million. Hold on to the $1 million forever, but any interest, investment earnings and interest earned off this $1 million, you can use that to run the park. We account for that where? In a permanent fund. We have that cash or whatever, investments, $1 million. We have the revenue coming in from those. And then we have what? We have the expenditures, which is only spending the interest, can't spend the corpus, the principal, only spend the interest on actually running the park in that example. Okay. Okay, good. Our proprietary funds, 2 of them, Internal Service Fund and Enterprise Fund. We'll get to the fiduciary funds here in a minute. Okay, so let's take a look at our proprietary funds. Okay, and we are treating this as though it is a business being run inside the government. So we will be using full accrual accounting, and we will have capital assets, and of course we'll depreciate them. By the way, governmental funds do not report depreciation. How can there be? There's no fixed assets, so there can't be depreciation. So the governmental funds do not report depreciation, but when you get down to the proprietary funds, yes, you report depreciation. We're back to the term expenses, not expenditure. Expenses are saying that the future economic benefit associated with that money you spent has expired. Expenditure means that you spent the money, but the future economic benefit is not necessarily expired yet. Thus, we have expenditure capital outlay because there's still future economic benefit associated with that. Okay. We report our statement of net position using the format that we learned for our government-wide statements. Only the fund financial statements follow this format. So we're going to have our what? We're going to have our all assets now, guys. We're back to full accrual accounting. All assets, right, minus all liabilities is going to give us net position. So that bottom line is the difference between our assets and liabilities, and we don't do this. We don't roll the numbers back up and report the total. And we saw in the example for our governmental funds, the typo where it didn't add up, but it should add up. Those two numbers should match. The total assets, total liabilities, and fund balance, those should match, but we only report it that way for our governmental funds. For our proprietary funds, we simply show the difference between the assets and liabilities as the net position. Net position is like retained earnings, just like we did for the government-wide level. Okay, and so we already actually looked at this, okay, when we were playing around and seeing how we could roll up the proprietary funds to the government-wide level. But here's this picture again: water, sewer, and parking. And then we also report our internal service funds right here. So we have all of our proprietary funds, 2 enterprise funds. There's usually only 1 internal service fund reported right here at the fund level. Okay, and again, the difference between our assets, current and non-current, our liabilities, current and non-current, all assets, all liabilities, full accrual accounting, difference is our net position. And then we have 3 categories of net position: restricted, unrestricted, and net invested in capital assets, and it's net of any related debt. One of the things you would need to do in a consolidation that gets a little irritating is you would have to take those that are called restricted, as we've learned for our fund balance, and those are going to be called restricted at the government-wide level, because at the government-wide level, they're still called restricted. But then we're going to have to take all the other categories that we have for fund balance and include those in unrestricted. So it gets a little tedious. We won't do that in this class, but just to point out the relationship between what's reported restricted at the fund level and what gets reported as restricted at the government-wide level, which has these three same categories: restricted, unrestricted, net invested in capital assets. You would have to kind of tease those out and tease 5 categories into 3 when you go to the government-wide level. Okay, so government-wide level, and I'm kind of jumping around a little bit, has these same 3 categories, is what I'm trying to say, as we show for our proprietary funds. Okay, when we look at our operating statement, we call it the statement of revenues, expenses, and changes in fund net position, almost identical to what we do in commercial. We have what? Operating revenues, operating expenses, right? Notice we got depreciation expense here because we're back to full accrual accounting. And then you come down and you have what? Non-operating items, very similar to commercial. Interest revenue, interest expense are typically non-operating items, right? Okay. And then you end up with the change in net position. Change in net position is like net income. You add that then into the beginning balance of whatever your net position was, and that yields you the ending balance. So you sort of have, for all of these statements, you have a combined income statement and statement of changes in retained earnings. Statement of cash flows, all I'm going to say to you is that yes, the proprietary funds have to prepare a statement of cash flows. That's all you need to know right now. We're going to get into the format for it when we get to chapter 7, talking about the proprietary funds. Okay, internal service fund, I've given you the example. A motor pool, internal service fund basically provides services to the other funds. So when the general fund needs to have the fire truck taken care of, the general fund will do what? Send that fire truck over to the internal service fund. They work on it. They bill the general fund. That's a revenue to the internal service fund. That's an expenditure to the general fund, right? And then when the time comes to pay that bill, they'll transfer the cash over the way we've talked about with the transfer in, transfer out. Okay. Enterprise funds just try to cover costs, but the customers of the enterprise fund are not the other funds. It could be what? Could be citizens, could be those outside the government. Now, it doesn't mean that the other governmental funds will never use those services, but most of the use of that service comes from outside the government. So the fire department would still use water, let's hope not a lot, but they would still use water, but most of the revenue for the enterprise fund comes from what? Businesses and individuals using water, and they're outside of the government. Again, that's under the business type activity at the government-wide level. I think I didn't mention it here, but we already know it, that the internal service fund is reported under governmental activities column at the government-wide level. We already knew that. Okay. 3 statements: statement of net position, statement of revenues, expenses, and change in fund net position. Again, I want to make sure we're remembering that only the proprietary funds prepare the statement of cash flows, and we've talked about that. Okay. All right. How about our fiduciary funds? And all I want you to understand right now is that we have the fiduciary fund category, custodial funds, investment trust funds, private purpose trust fund. pension trust fund. Okay, and so that's going to give us KIP as our mnemonic. Okay, on our statements, okay, we have additions and we have deductions. Okay, additions are like our revenues, deductions are like our expenses. Remember, we do not consolidate the fiduciary funds at the government-wide level. Notice that we follow that same format that we saw for the government-wide, that we saw for our proprietary funds, and now we're seeing that that same format is used for the fiduciary funds. So only the governmental funds do this. Everybody else shows their balance sheet this way. Okay. So let's take a look at this question. The format for the presentation statement of financial position for the fiduciary funds adheres to the following, and you can see that C is the answer here. Assets and deferred outflows minus liabilities and deferred inflows. Remember, we put the outflows with the assets, the inflows with the liabilities, equals net position. It simply takes the difference between those as that bottom line that we reported as our net position. Okay, and maybe that slide should have gone after this one, but here's our assets. Most of the assets, the lion's share of the dollar value of the assets for the fiduciary funds are reported at fair value. For example, investments that pensions make are typically things like stocks and bonds that would be carried at fair value. Okay, difference between assets and liabilities is called net position. All of this is considered restricted, guys, because it's what? It's held in trust and must be used for the beneficiaries of whatever fiduciary fund, if it's our pension, for our employees. Again, only the proprietary funds prepare the statement of cash flows. So this is the income statement. We call it the statement of changes in fiduciary net position. And we have additions or like revenues, for example, the contribution from the employee and the employers. These days, most public pensions require the employee to also contribute to their own retirement. Okay. Of course, there needs to be some earnings on that. And then we have our expenditures, which we call deductions. And we have the amounts paid out for refunds of contributions for people that leave the government who've made contributions but probably haven't invested yet. So we kick them back their money, okay? And of course, those that stay long enough to collect benefits, as they start collecting those pension benefits, that's going to be listed as a deduction, which is like an expense, but we call it deduction, and that would be the benefits. Okay, and then you have the change in net position. Change in net position is like what? Like net income. Okay, and you see the different funds, guys: custodial, investment trust fund, private purpose trust fund, and then the pension fund. Okay, and I'm not going to get into the details of these now, because we're going to cover all of these in chapter 8 and the nature of the type of things that they do. Okay, so this slide comes back now, and that these are the main things I want you to know. I want you to know the 3 categories, the 11 fund types that fall in to these 3 categories, right? I want you to understand where these funds appear at the government-wide level. Okay, and then I want you to know the type of accounting that is used by each of these, and it's pretty easy. Only the governmental funds follow something other than full accrual accounting, economic resources, measurement focus, and the operational accountability focus, which is, what am I saying here? All the funds follow that except who? Except the governmental funds, which follow modified accrual, current financial resource measurement focus, fiscal accountability. So when you look at this slide here, this slide basically has everything, okay? And then the only other thing I want you to have taken now from chapter 2 is the structure of the financial statements, right? We have what? We have our all assets, all liabilities, net position for everybody but the governmental funds. Governmental funds are going to be what? Current assets, current liabilities, fund balance, and then we do add those up to report to the total that matches the total of assets, liabilities plus fund balance. We have the 5 categories of fund balance: restricted, committed, assigned, and unassigned, RECO. And then we have the non-spendable, like inventory and prepaids, okay? We talked about the structure of the financial statements. We talked about how we have the sort of upside down income statement, statement of activities at the government-wide level. When we get to the fund level, we have revenues, expenditures, but then we break off what? Other financing sources and uses separately. Our other financing sources, there are 2: long-term debt proceeds, like bond proceeds, and what? Transfer in. Other financing uses, there's only 1: transfer out. All of the categories only prepare 2 statements, a balance sheet and income statement, except 2. The proprietary funds have a statement of cash flows, okay? And along with those other 2 statements, balance sheet and income statement, so we have 3, okay? Those are the main takeaways, guys. Not quite, you know, way up here, 30,000 feet. We got a little bit more into the terrain. What we're going to do next time is finish up chapter 2, talking about something called major funds, okay? Right here, I'll give you a major fund example, okay? This is just a review of how we'll roll up the individual funds into the governmental activities and the enterprise funds into the business type activity column, but we've done that enough. I'm going to start here next time, reporting of major funds. We'll look at the quiz for the practice midterm for chapter 2, and we'll knock out as much as we can for chapter 4 next time. Okay? Question? Okay, guys, if there are no questions, I will see you on Thursday. I recommend that you know what you could do? Look at chapter 2, practice midterm. Take a look at that. I think you'll get more out of it if you review it prior to class next time than if you sort of wait for me to go through it with you. So take a look at that. We'll go through it together, but take a look at that. And then once we finish this little bit and then that, we will go ahead and start to jump into chapter 4. Okay, guys.
Yes, sir. Thank you.
No questions. We'll see you next time. All right.
Thank you.
Thank you.
Thank you.
Bye-bye, guys.
Sir.
Okay. Have a good night.